I want you to take a look at that little area right here on TradingView. At the time of watching real-time price data, generally you're going to have electronic trading hours highlighted, and it would look like this in your TradingView. If you have live data and you paid for that live feed from TradingView, you can toggle from electronic trading hours to regular trading hours and see more detail. So if you click on that, it's going to change it to an option of regular trading hours or electronic trading hours. If you toggle it to regular trading hours, your chart would show this. Okay, and this is what I teach, is the opening range gap. Okay, now I taught this to charter members, I taught this to old ICT mentorship students, and this is not something that has been just introduced because other people have talked about it recently. I've been doing this since 1996. So these are things that, you know, they have been there in the marketplace all this time. And while I don't claim the real estate here, you know, as a creator of this, it's just this is one gap I like to see used. Now, if you take this gap, and I'll explain what I mean by that, the closing price, the previous session, and where we open at 9:30, that is the opening range. If there's a gap and we gap higher and we're bullish, this is how you use the information. You expect price to trade down to it, reprice to the gap, and then go higher. Move away from the direction of the gap after it fills. If we are bearish and we see a gap like this, then it could become a trade lower, fill the gap, consolidate, false run, and then break lower. Or if we're in consolidation and we have already met some higher time frame weekly objective and we have a gap higher like that, then what can happen is once the gap fills, nothing happens. It just uses this entire gap throughout the day. But because we've been bullish, as I highlighted yesterday, it's a gap higher, opening, fills, and reprices down into that opening range gap low, which is where the session closes on regular trading hours the previous day. You can always find that price by simply just toggling the electronic trading hours to regular trading hours. This is why the RTH is down here. You'll see that separation here. So what's hiding is all the electronic trading from where it traded yesterday at settlement to where we opened at 9:30 opening bell in New York local time in New York. So that difference there is going to be sometimes shown as a gap. It could be a gap higher like we see here, or a gap lower, or it could be unchanged. We would like to see a gap of some kind because a gap always creates an inefficiency, and inefficiencies are many times, not always, many times repriced too. And how we use that information is paramount going forward. What I teach, this is something that's unique to me, this gap, once it's completely repriced, then if we're bullish, we can take that gap and do multiplications of that and project it higher. So if you take that range from the low to the high and you multiply it up, you can get 2 standard deviations, which essentially gets us real close to the high without even needing that premium fair value gap that's in the pink area. Okay, but look at the respective of that premium fair value gap I've highlighted. I mentioned this again on Twitter beforehand in tweets. So just go back and look at the stuff I put up. I didn't put very many tweets up this week. Go back and look at them in a little short vignette that I talk about, you know, for imbalances and where, you know, everything is, you know, trading and such. And then look at it on your charts.